In the second part of this video, we'll talk about more detail about the kinds of mutual funds. And when we talk about kinds of mutual funds here, we're really referring to strategy, right? What is the objective that this corporation is trying to achieve? So as we go through here, I think you'll find it not only there are different types, if you will, but there's also difference of strategies of how mutual funds ultimately work. We've already talked about open end and closed end, and that's it's a type of a structure, if you will. But there are other mutual funds that invest in things other than things like stocks and bonds. So the first kind of mutual fund we'll mention is something called a real estate investment trust, or a REIT. Essentially, these things obviously work in real estate. There's three basic types, right? There are those that invest in property. So these are property/equity REITs. There are those that only invest in mortgages. And then there are those that are hybrids and they invest in both things. So these things are slightly different than a mutual fund. When we talk about mutual funds, typically we're talking about buying securities. But this is a type of an investment company that actually buys property. Hedge funds are another type of investment company, not dramatically different from what a mutual fund looks like, but as far as operations, they are very different. These are pooled investment funds. All right, they accept money and they invest those on a collective basis, but they're not a corporation. They're essentially usually created as a limited partnership. There's no regulation like there is for mutual funds. The general partner, the person that runs this mutual fund, typically takes 10 to 20% of the profits, right? The other investors are what are referred to as limited partners, right? To buy one of these hedge funds, you have to be pretty wealthy. Essentially, you need to have net worth greater than $1 million and or annual income over $200,000. So you have to have a fair amount of dough in order to invest in a hedge fund. And the challenge we have here is, quite frankly, for me, is the regulation side. Is that they can take some very complex positions. So the hedge fund or whoever's managing this money can actually take some very aggressive stance. They can use things like options, futures, other kinds of derivative securities. They can take short positions, long positions. They can make a lot of investments. They can make a lot of money, but they're also very volatile and they're also very risky. So now that we've talked about the different kinds, right, let's talk about policies and objectives, right? The nice thing about most mutual funds is for a vast majority of them, the name of the fund also might describe its policies. So there might be something in there that gives you a hint. A growth fund, as an objective, is looking for things that have capital appreciation. So these are looking for well-established, large cap types of companies, have above average growth potential, typically have very little dividend income. And they're typically, since we're looking for this growth potential, they're also a little bit greater than average risk. Now, an aggressive growth fund, instead of looking at large or mid-cap companies, they're going to concentrate on more smaller and unseasoned companies. Typically, they'll have some high PE ratios. They're very volatile. When the market does well, these mutual funds do really well. However, when the market does bad, these types of funds actually perform very poorly. Value funds combine their investing the things that the marketplace, or the investors in this case, feel are undervalued by the market. They're going to focus on the intrinsic value of stocks and and looks at fundamental analysis. So they're really going to take a very close look at all of these companies. Typically, the company is going to have low PE ratios, high dividend yields, they'll have moderate amounts of financial leverage, right? So typically, these are going to be a little less risky investments. And if you're looking for some fairly decent returns at low risk, this might be a mutual fund that might have an interest for you. Equity income funds, since the definition, right? They're going to purchase stocks with high dividend yields. So they're looking at high current dividend income. And of course, they're always looking for something that might also grow in value, right? So they're going to concentrate heavily on high grade common stocks. May have some convertible securities in there. They may from time to time invest in junk bonds, right? Just to help boost some of the earnings and give it a little bit of a kick. But they're going to lean heavily towards blue chip funds, right? They're typically less volatile, and are viewed as being a fairly low risk of investing in stocks. Balance funds are going to combine both stocks and bonds in a portfolio. They're going to obviously use the bonds to help provide some current income, and stocks they're looking mainly for growth potential. So again, compared to the stock market in general, we might think that these funds would be a little bit less risky than funds that invest exclusively, in common stocks. Growth and income funds, they're going to try to find a balance made up between current income and capital gains. Most of their money is going to be in equities. They're going to try to confine most of the investing into quality issues. So they're going to look at growth-oriented blue chip stocks, high-quality income stocks, but they also open the door to invest in bonds so that they can provide returns. When bonds are doing well, they may move towards the bond market. So again, they mentioned that these things might have a fair amount of risk, right? So that they're most suitable, quite frankly, for investors who can tolerate the risk level. So they are going to be a little riskier, right? But they're not as risky as a total bond fund or an aggressive kind of a growth fund, since they're combining some capital gains, etc., in their investment. Bond funds, we know that there are certainly bonds on the world, right? So these are exclusively invested in bonds. So the advantages that they're going to give us over stock funds, they're going to be a little bit more liquid. They're going to offer higher diversification within the funds themselves. And the bond funds automatically reinvest interest and income. So compound interest and growth of investment is by their very nature happens automatically. And again, if you remember us talking about bonds, right? As long as the companies don't go bankrupt, the cash flow is certain. So since we're investing in fixed income securities, we know that this interest is going to be paid every month. So there is some perceived growth that's expected just from reinvestment and compound returns. And there are many different types of bond funds, right? You can invest in the United States government, corporations, municipal bonds, intermediate term bonds. All of these different funds, if you will, have a particular strategy or an objective, right? Government bond funds only invest in United States Treasury and agency securities. A high-yield corporate bond fund is only going to invest in junk bonds, etc. So, again, as we've talked about as we go through this, all of these funds, they have a strategy or an objective that they have to follow. And as investors, you look to those types. If you want to buy a bond fund, you wouldn't look at stock funds because there's no bonds in stock funds. If I hopefully that makes a little bit of sense, right? So you're going to purchase bond funds or mutual funds that meet your particular investment needs. There's things referred to as a money market mutual fund. These are short-term money market instruments like T-bills, bank certificates of deposits, commercial paper. Typically, they only have 90 days of life for these instruments. So returns are going to go up and down with interest rate conditions, right? But about 95% of these funds' assets are invested in top-rated prime-grade securities. So they are considered a fairly safe, convenient way to accumulate capital, right? And a place to store idle funds. And it's the fact this is a vehicle that you might consider using instead of a bank as a savings account. It's very easy to get your money. In fact, some of these money market mutual funds will provide you with checks. So you can write a check against your mutual fund account. Certainly there's easy access. A bank's easy to get your money as well, but there's easy access to your money, and quite frankly, they probably pay a higher rate of return than a bank savings account might pay. So with these money market mutual funds, again, there are some different purposes, right? There's different types. So you can just buy a general purchase money fund. It invests in all kinds of money securities, but you can buy a government money market fund. You can buy a tax-exempt money market fund. We talked about these when we talked about municipal securities. So they're only going to invest in 30 to 90-day tax-exempt municipal securities so that you get tax-exempt earnings from the interest earned from these types of securities. There are index funds. Essentially what they try is they buy or hold a portfolio of stocks or bonds equivalent to those in a specific market index. So the objective is to match, not beat the specific index. These are typically thought as being low-cost investments because a lot of the management, quite frankly, is done by computer. So a computer is going to buy and sell based on the marketplace. So a strategy for an index fund is to buy and hold. This provides some tax advantages, right? Since there typically doesn't trade that often, so there's going to be very little taxable capital gains, but you would have access, obviously, to the dividends or the interest that is paid by these securities. There are mutual funds are referred to as sector funds, right? These are investments that are restricted to a particular part of the market. For example, a healthcare sector fund would only focus on stocks that are issued by drug companies, hospital management firms, etc., right? You can find technology funds, financial services funds. REITs are certainly an example of a sector fund. But you can also find what are referred to as socially responsible funds. We'll talk about those here in a second. But the objective is to produce capital gains, right? To find a sector and to capitalize on those sectors that may have some potential of growth in the near term. So they're considered fairly speculative because you do have some limited diversification since we're only looking at individual parts of the economy, if you will. Now, I had mentioned socially responsible funds, but these funds basically are attractive to maybe pastors, but in general people that may not want to contribute to the investment in certain types of activities. So, they evaluate stocks based on financial criteria, but they also look at moral, ethical, and environmental kinds of tasks. So, if you don't meet their needs, their guidelines here, then that investment would not be considered appropriate for this portfolio. So excluded kinds of companies would be tobacco, gambling, weapons, fossil fuels, right? Again, these companies wouldn't be part of socially responsible funds. Now, there are a series of types of funds that are sometimes referred to as sin funds. So sin funds are going to concentrate on those kinds of companies that socially responsible funds exclude. Now, the question in the end is, can you get a decent rate of return by excluding these types of securities, right? These types of companies. And some socially responsible funds perform very well, and some not so well. There are things referred to as asset allocation funds. Essentially, what these funds do is they are going to spread their money across all different types of asset classes. So it kind of provides some built-in asset allocation, if you will. And as market conditions change, they can manage the asset allocation to provide higher returns when the opportunities present themselves. And some of these might be referred to as target date funds. There are many mutual funds that offer these as retirement vehicles. So you can buy a retirement 2050 mutual fund. So the asset allocation strategy with these mutual funds is to create a mutual fund for a person that's going to retire around 2050. Again, it's a retirement type vehicle. They rely typically heavily on stocks, and of course they move back and forth as the economy dictates. You can also buy international funds. Now, this is where you have to kind of look at the words, and the words are if it's not in the title of the fund, it certainly is in the prospectus. But an international fund, right, or international funds do not invest in investments in the United States. So they'll provide the greatest amount of potential of diversification if you live in the United States. Now, there are funds that are referred to as global funds. Because the United States equity market is the largest, it's going to be the largest part typically of these mutual funds. So you're going to achieve less international diversification if you buy a global fund relative to an international fund. And certainly you can find funds that invest in stocks, bonds, money markets. They have funds that look at international growth, international value, and they also look at specific parts of the world, right? So you can buy a China fund, you can buy a Europe fund, right? These would specialize on specific parts of the world or regions of the world. So that's our basic concept, if you will, of the different types of strategies and objectives that take place inside the mutual fund. So now we know the different types of funds, and we know the different categories of strategies that those funds will follow. And so that's the end of the part 2 of the mutual fund video.